Ever feel like something's nibbling away at your investment returns? Like you're doing everything right, but those gains aren't quite what you expected.
It's a sneaky tax, right?
Exactly. And today, we're diving deep into the often overlooked world of investment fees. We'll uncover where those pesky fees are hiding and, more importantly, what you can do to fight back.
Because let's be honest, no one likes leaving money on the table, especially when it comes to investing your hard-earned cash.
Absolutely. And this source doesn't sugarcoat it.
Yes.
It dives straight into the fact that fees could cost some folks millions over their lifetime. Millions. It's a wake-up call to take control and understand where our money's going.
It's surprising how many people fall into the trap of believing higher fees equal better returns.
Right. Like, it's got to be worth it if it costs more, right?
Well, this source does a fantastic job of debunking that myth. It highlights that there's absolutely no guarantee that even the experts will outperform the market.
Which reminds me, remember all those disclaimers we often scroll past? You know, those past performance is not indicative of future returns.
Yeah, those. Yeah. They aren't just legal jargon. They're trying to tell us something. Investing always has an element of risk, and fees are one of the few things we can actually control.
100%. So let's get into the nitty-gritty. This source talks about actively managed funds versus passively managed funds. Okay, active funds. They sound exciting, right? Like a high-performance sports car, constantly shifting gears, trying to beat the market. But,
like a sports car, all that fancy maneuvering comes with a hefty price tag. We're talking fees.
Big ones. Think 1.25% to 2% on average. Plus, all those sneaky extra charges like sales loads when you buy in and redemption fees when you sell. Ouch.
It's easy to get caught up in the allure of someone actively managing your money, promising to outsmart the market.
Yeah, who doesn't want to beat the market?
Right, but the data tells a different story. Very few actively managed funds consistently outperform their benchmarks after those fees are factored in.
So let's talk about the more laid-back approach. Passively managed funds, like your index ETFs.
Think of them like a reliable sedan. They aren't as flashy, but they get the job done. They aim to match the market's performance rather than trying to outrace it.
And the best part?
Significantly lower fees, often dipping below 0.01%.
Yeah. We're talking a fraction of what you'd pay for those high-flying active funds. And you know what they say. Slow and steady often wins the race, especially when it comes to long-term investing.
And when we're talking investing, those tiny percentages can snowball over time, thanks to the magic of compounding.
It's crazy how much of a difference it makes. The source gives this example. Say you invested $100,000 in an S&P 500 ETF with a 0.09% fee. Now compare that to a fund charging 1.25%. Seemingly small difference, right?
Not so fast. Over 30 years, that difference could cost you almost $250,000. Let that sink in for a second.
Seriously, folks. It's like finding a hole in your wallet, but instead of losing a few bucks, you're potentially missing out on a small fortune.
And we haven't even touched on registered investment advisors. They often charge fees based on your total investments, usually between 1% and 1.5% annually.
And don't forget about those do-it-yourself trading platforms. They might seem appealing at first, but watch out for those per-trade fees. Especially if you're a frequent trader, they add up fast.
It all boils down to this. Don't just hand over your hard-earned money without fully understanding the costs involved.
Knowledge is power when it comes to investing. Ask questions, read the fine print, those fee disclosures, and don't be afraid to negotiate.
Absolutely. Ask about the value they bring to the table and if it truly justifies those fees. Shop around and compare different options.
This whole deep dive has me thinking we often get so fixated on potential returns that we sometimes overlook the impact of fees. It's like being obsessed with a car's gas mileage, but ignoring insurance, parking, and maintenance costs.
That's such a great analogy. You need to look at the full picture.
Exactly. So here's your takeaway. Next time you're evaluating investment options, don't just focus on the potential gains. Remember those seemingly small fees. They might be the silent wealth killers in your portfolio.
Choose wisely, my friends. Choose wisely.